Right now, as we watch the market in real time on this Wednesday, December 10, 2025, JPMorgan Chase is trading at exactly $303.73 per share. That is a solid intraday push, putting the stock up $3.22, or roughly 1.07% from the opening bell. If you are watching the tape, you are seeing a stock that is fighting back after a bit of a wobble, pushing through resistance levels that many day traders thought would hold it down. The volume is heavy, the institutional orders are flowing, and the price action suggests that the bulls are trying to reclaim the narrative after some recent concerns about rising expenses. Most people look at a bank like JPMorgan Chase and they see a fortress. They expect a slow, steady, impenetrable dividend payer that moves with the predictability of a supertanker. That is the expectation. You buy it, you hold it, you collect your yield, and you sleep well at night. But the reality I'm seeing in the charts and the filings today is something far more aggressive and, frankly, far more interesting. The reality is that JP Morgan is not acting like a legacy bank anymore. It is acting like a predator that is willing to sacrifice short-term margins to absolutely dismantle its competition. When you see a company this size signaling that it is going to ramp up expenses by $9 billion in 2026, as they just indicated, the knee-jerk reaction from the street is panic. They sell. They worry about the bottom line. But if you look deeper, you realize that this spending isn't waste. It is a moat-widening exercise designed to make it impossible for smaller players to keep up. That is the tension we are trading today, the fear of lower profits versus the reality of total market dominance. Let's talk about what is actually moving the needle right this second. The stock opened this morning around $300.50, and we immediately saw a dip, a classic shakeout of the weak hands who were spooked by the expense guidance released earlier this week. But notice what happened next. It didn't break. The buyers stepped in at that $300 psychological level, a massive support zone that we have been watching for weeks. This is where the smart money lives. While the retail crowd might be chasing Tesla stock or trying to time the next breakout in Nvidia stock, the institutional giants are parking capital here, treating that $300 level as a floor. We are seeing a bounce off the 50-day moving average, which is a bullish technical signal that often brings the algorithm-driven traders back into the fold. The volume today is trending above the 10-day average, which tells me this isn't just a dead cat bounce. This is accumulation. When we analyze the flow of funds today, we are seeing a rotation. Capital is moving out of some of the more speculative, high-beta tech names and finding a home in high-quality financials. This is likely a defensive posturing by portfolio managers who are looking at the calendar, seeing the end of 2025 approaching, and wanting to lock in gains while parking cash in a vehicle that offers both safety and upside. It's the classic flight to quality trade, but with a twist. Usually, you buy a bank for safety. Today, you're buying JP Morgan because it is arguably the only financial institution that has successfully pivoted to become a technology company. You compare this to Apple stock, where the value is in the ecosystem. JP Morgan is building that same ecosystem in finance. They want you to have your checking, your mortgage, your credit card, and your wealth management all in one app, and they are spending billions to make that user experience seamless enough to kill off the fintech threat. This brings us to the broader competitive landscape, which is essential to understanding why this stock is moving the way it is. For the last 5 years, we have heard endless chatter about how fintechs were going to disrupt the big banks. We heard about SoFi and their aggressive push with SoFi Invest, offering everything from SoFi Active Investing to SoFi Robo-Advisor services. The narrative was that these nimble, digital-first players would steal the younger generation, and to some extent they did. SoFi stocks and SoFi ETFs became popular. Then you had Robinhood. The rise of Robinhood stock trading was a cultural phenomenon. They hooked millions of users with the Robinhood app, offering Robinhood crypto, Robinhood fractional shares, and Robinhood cash management. It forced the entire industry to change. It forced zero commissions. It forced better mobile interfaces. But here's the reality check. JPMorgan didn't just roll over, they adapted. They launched their own digital tools. They eliminated fees where they had to, and they leveraged their massive balance sheet to offer rewards and interest rates that the startups simply cannot match in a high-rate environment. When you look at the landscape of investing sites, it's crowded. You have Schwab Intelligent Portfolios offering automated solutions. You have the rise of self-investing platforms where people want to invest online without a human broker. There is a massive demand for investment help that is low-cost and digital. JPMorgan saw this and integrated it directly into their Chase mobile app. They didn't build a separate brand, they just made their existing ubiquitous app more powerful. This is the difference between a company like Interactive Brokers and JPMorgan. Interactive Brokers Trading and the Interactive Brokers platform are fantastic for professional traders who care about Interactive Brokers fees and margin rates. But for the average American, the friction of opening a new Interactive Brokers account or figuring out Interactive Brokers stock trading is too high. They already have a Chase card in their wallet. JPMorgan is betting that convenience wins. And looking at the stock price today, the market is starting to agree with them. We need to discuss the elephant in the room, interest rates. We are late in 2025, and the Federal Reserve has been navigating a tricky landing. Rates are not at zero anymore, and they likely won't be for a long time. For a bank, this is a double-edged sword. On one side, high rates mean they can charge more for loans. Their net interest income, or NII, has been a massive driver of profitability. But on the other side, high rates slow down the economy, they hurt the mortgage business, they cause defaults on credit cards, and they increase the cost of funding, the interest the bank has to pay you to keep your money in a savings account. JPMorgan has managed this spread better than anyone. While other regional banks faced liquidity crises because they were underwater on their bond portfolios, JPMorgan had the fortress balance sheet to weather the storm. In fact, they benefited from the turmoil, acquiring assets at pennies on the dollar when other banks failed. This is why when you consider individual brokerage options or look at Fidelity investments, you often see JPMorgan funds as core holdings. They are the survivors. But let's look at the specific catalyst of the Todd Combs news that is circulating. The fact that JPMorgan is attracting talent from the likes of Berkshire Hathaway, people who are disciples of the Warren Buffett School of Value, signals a shift. It suggests that the bank is doubling down on its asset management division. They don't just want to lend you money, they want to manage it. This puts them in direct competition with Fidelity. When you think of Fidelity Wealth Management or Fidelity IRAs, you think of long-term retirement planning. Fidelity ETFs and Fidelity mutual funds are staples. Their Fidelity mobile app and Fidelity trading platform are top tier. By bringing in high-profile investment talent, JPMorgan is signaling that they are coming for that market share too. They want to be the premier Fidelity brokerage alternative. This is a high-margin business. Lending money is capital-intensive. Managing money is fee-based and capital-light. If JPMorgan can successfully shift its revenue mix more towards asset management and away from pure spread lending, the stock deserves a higher multiple. That is the re-rating trade we might be in the early innings of right now. Now, I want you to take a second and think about your own portfolio. It's easy to get caught up in the hype of the day, but I'm curious. Comment below how many shares of JPMorgan you currently hold, or if you are banking on one of the fintech disruptors instead. Are you Team Jamie Dimon, or are you betting on the digital upstarts? Let me know in the comments. Let's pivot to the financials and the boring stuff that actually drives the stock price long term. The bank operates in four main segments: consumer and community banking, corporate and investment banking, commercial banking, and asset and wealth management. The consumer division is the engine. It is the branches, the credit cards, the auto loans. This is where the cost of living crisis hits hardest. If the average American is squeezed, they spend less, they borrow less, and they default more. We have seen credit card charge-offs tick up slightly in the recent reports, which is a yellow flag. However, the corporate and investment banking division is the wild card. When IPO markets open up, when mergers and acquisitions heat up, this division prints money. In 2024, the deal flow was sluggish. As we move through 2025, we are seeing green shoots of activity. If the regulatory environment shifts to be more pro-business, we could see a massive unleashing of pent-up merger demand in 2026. JPMorgan is the #1 fee earner in that space. If the dam breaks, they catch the most water. We also have to talk about the technology spend again. $9 billion is a staggering amount of money. To put that in perspective, that is more than the entire market cap of many mid-sized companies. What are they buying? They are buying AI. They are buying